Hey, what's going on YouTube? Welcome back to Tech Conversations. I'm your host Guillermo. It is April 3rd. Hope you're all having a great weekend so far. Let me know in the comment section below where you're watching this video from. Always curious to see where all of you are located. Now in today's video, I want to talk about a strategy that can help us generate steady income every single week. This strategy will help us limit our risk and requires a very small amount of money. So we'll see how we can take $50 and make $1,200. So before I get into that, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Let me know if any of you guys are using this strategy and with which stocks. So this strategy is going to be employed during periods of lower price volatility. So in other words, we want to find a stock that's not volatile, a stock that for the most part trades sideways between a pretty defined range. And so here's what my favorite stock for this strategy is. It's going to be ticker symbol T, ATNT. Why? Because if we take a look here, for example, in the last week, and we take a look at the price action for AT&T, it literally stayed in the $30 range. It did not go above 30, did not go under 30. It was in the $30 range here. So for the most part, AT&T, not volatile at all, likes to trade sideways. This is the type of stock you want for this strategy. Now remember that you need to enable options on Robinhood for you to be able to trade options. So make sure that you've done that. And once you have, you can go over to the options here for AT&T, and we're going to set this up. So ultimately here, we're going to combine a bear call spread or a call credit spread with a bull put spread or a put credit spread. So we're going to take a look at an example here. Then we'll go over to bar chart, or not bar chart, options profit calculator, and we'll chart it there so we can kind of get a visual as to how this strategy here will look like. But ultimately, these will all have expiration dates that are the same. It's going to require 4 different contracts. So the first thing you want to do here is that you want to kind of figure out what price you think the stock will be at on expiration date. So we're going to leave our expiration date as April 9th here. So the first question you would ask yourself is, what price do I think AT&T will be at on expiration date? So let's say I think it'll be at $30.50. Cool, I'm going to use that strike price then. I'm going to use $30.50 here. So the first thing we're going to do with that is we're going to sell a call and sell a put at that strike price. So I'm first going to sell the call here at the $30.50 strike. So I'm going to sell it right here. So for this one, we're going to receive some premium. We're going to receive 21 cents per share. Remember, each one of these contracts controls 100 shares. So we're going to receive $21. Now we're also going to do the same, but we're going to sell a put there at the same strike price, $30.50. For this one, we're going to receive 64 cents per share, $64 for the contract. So far we're receiving a credit of $85. Now we got to buy our call, and so we're going to go to buy call here. So the strike price you want to choose here should be the price that you think this stock will not go above by expiration date. So on expiration date, April 9th, what price do I think AT&T will not be above? And I'm going to choose 31. I don't think AT&T will go above $31 on expiration date. So that's what I'm going to choose here. Now for this one, since I'm buying it, I'm going to have to pay 8 cents per share, $8 per contract here. Finally, we're going to buy our put. This one will go down here. And so again, same thing. What price do I not think AT&T will go under on expiration date? So I don't think AT&T will go under $30 on expiration date. That's the strike I'm going to choose here. So I'm going to click. I'm going to pay 30 cents per share, $30 per contract. So as you can see, 4 contracts here. If we continue here, remember, you can always do as many contracts as you want. Let's just keep it at 1 for now. So this is going to be a min credit thing. So we're going to receive money. We're going to receive a credit. We're going to receive $48 to open this. This, by the way, is called the Iron Butterfly. And if we take a look here, if we keep going and we review the order, collateral is going to be $50. So we're putting up $50, but we're receiving $48. That means that our max risk here is $2. The most you're going to lose here is $2, guys, to potentially make $48. We're risking $2 to make potentially $48. Meaning that if I were to purchase, for example, 50 contracts, I would be putting up $2,500, but I'd be receiving $2,400. I'd be risking $100 here to potentially make $2,400. That's a 2,300% return right there, guys. Okay, And so as you can see, this strategy, our risks is defined, our reward is defined. We need a relatively small amount of capital, right? If we're only opening up one contract, we only need to put up 50 bucks, and we're really only risking $2 here. Now, one thing I do want you guys to note here, of course, is that this is not going to tell you up here that it's an iron butterfly like it does with, a strangle or with credit spreads, debit spreads. So you got to make sure that you're setting this up correctly, because again, there's going to be no visual here that this is an iron butterfly. So be careful with that. The other thing I do want to mention here before we go to the options profit calculator is that if you're not on Robinhood, you need to watch out for commission costs. On Robinhood, there are no commission costs, so we don't have to worry about that. But you are opening up and closing 4 contracts. So if you're on a broker that does charge commission, that might eat away at the credit that you're receiving here. So keep that in mind. So with that being said, let's jump over to the options profit calculator now. Let's actually take a look at how this visually looks like. So here's the options profit calculator. Really great tool to visually see what your profit or loss is depending on what the price of the stock is, depending on what date it is. So again, this requires 4 contracts. Let's just start from scratch. We'll go to custom and we'll go to 4 legs here. So what we're going to do is we're going to enter the symbol of the stock. In this scenario, it is T. We can get the price for this. And so as you can see, there's going to be 4 contracts. So let's start off with selling our put and selling our call. We're going to do the exact same trade we just did. So let's go to write or sell, and let's start with our call here. So again, make sure you're always choosing the correct expiration date up here, guys. We chose April 9th. And then, of course, make sure that you're choosing the correct contract, because calls are on the left, puts are on the right. So be careful of that. So let's first sell our call here. This was the 30.50 strike, which is right here. So there we go. We're going to receive $21 here. Now let's go ahead and write or sell our put. Same thing, make sure expiration date is correct. Puts are on the right. We chose the 30.50 strike, which is right there. So we're receiving $64 for selling this contract. Now let's go ahead and buy our call option. Same expiration, calls are on the left. We chose the 31 strike here, so there it is. Finally, let's buy our put here. Same expiration, April 9th. This was the 30 strike, and then puts are on the right here. So there it is, guys. That is our trade here. And then let's go ahead and calculate and see how this actually looks like visually. So here it is. So in this scenario, we're going to receive $47 as a credit. Over there was 48, pretty similar. So entry cost 47, that's going to be a credit. We're going to receive $47 here. Max risk $3, $2. It's going to be a very small amount of money here. Our max return $47. Break evens at expiration are also given here. So let's actually take a look at this chart here. So as you can see, we want AT&T to be trading sideways. We do not want it to go up. We don't want it to go down. It's important that you're choosing stocks that are not volatile. They usually trade sideways. Again, I like AT&T for this strategy. So let's take a look here. So we're going to make our max return. We'll focus on expiration date. We're going to make our max return if the price of this stock is the same as the strike price of the call and put that you sold. That's why you got to choose, that's the first thing you do is you take a look at what price do I think the stock will be on expiration date. That should be the strike for the call and put that you're selling. So if on expiration date, AT&T's at 30.50, that's where we're going to make our max return of $47. Now break evens here. Basically what this is saying is that on expiration date, as long as you're between these two numbers, as long as you're between 30.03 and 30.97, you're going to make some money. If you're exactly on those two numbers, you're going to break even. If you're above 30.97 on expiration date, you will be losing all the money. But keep in mind that's only $3. And if you're below 30.03 on expiration, again, you're going to lose all your money. But again, that's only $3 you're losing. As you can see, depending on where you're at between that range, you will make some money. I mean, even if you made $37 here, as you can see, that would be a 1,233% return if AT&T was 30.40 on expiration date. So again, right, you want it to stay within a pretty narrow range here. But as you can see, you could potentially make a lot of money. A lot of people like using this strategy because, again, kind of a steady way to make some income. Of course, the probability of AT&T being exactly at 30.50 on expiration date are pretty low. But again, as long as it's in between, this break-even range, you're going to be able to generate some income every single week. Again, not a lot of money involved. So anyways, this is one of the most popular options trading strategies out there that a lot of people like to use because, again, it's just so steady, limits a risk. We know what a risk is. We know what a reward is. And again, relatively small capital. So if you have any questions about anything that I just talked about, feel free to leave them in the comments section below. Check out the Discord link to that in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.